More on today's sell-off. Let's bring in Jeremy Siegel, Wharton School professor of finance at the University of Pennsylvania. Professor, great to see you today. Thanks for joining us. What do you make of this market? What do you make of this market sell-off we're seeing right now? Do you see this as a pullback, or do you see this as something deeper?
Yeah, it's trade, and trade. That is by far the dominant issue, I think, that's affecting the market. Before Thanksgiving, everyone thought a deal was going to be imminent. Market sold, bought up to all-time highs, 2-3%. Now, Trump is saying maybe not. And you see the sell-off. Honestly, my personal opinion is this is just a negotiating tactic. Be really tough right before you make a deal. I still think he's going to make a deal by the end of the year. If he doesn't and trade tariffs get put on December 15th, woo. I don't know if I want to be around equities then.
What about if we split the difference on that, Jeremy? I think last time you were on, you said if we got a phase one deal, that was worth about 10% of upside. What if we don't get the phase one deal, but we also don't get December 15th tariffs, and essentially we just kind of go on into the election with the current status quo? What's that worth?
Yeah, well, I think that's a muddle through. I mean, if we just stand still at where we are now, deferring any more tariffs but not taking any off, then people say, all right, we are where we are. Now let's look at earnings and see how well they're going to do. This market is not cheap. 19.5 times this year's earnings. I look at around 18.5 times next year's earnings. I don't think we're going to get as high as 10-12%. So you can't have a lot of bad developments come on with that sort of valuation. With that, it's not a disaster, but it's much more modest and much more choppy, I think, if we just get a standstill.
So, of course, what is an investor to do? I mean, today the posturing is much more defensive. In terms of stocks, it's real estate and utilities. There are only two sectors in the S&P in the green. You see bond prices rising and the yields dropping again today. Gold is up. Are these the places where investors need to be right now, given all the uncertainty?
Well, I mean, really that bond, what we saw today just reemphasizes that Treasury bonds have become the hedge asset against equities. Boy, look at how they rose today so strongly when the equity market, over the last couple of days have, sold down 800 points. That's what it's being bought at. Yields are going to stay really low with Treasuries being a hedge asset like this. So, people are going to begin to think, where am I going to go for income? And I think this reinforces the fact that it isn't going to be bonds. That's why financials are under pressure. Obviously, lower interest rates are not good for financials, but that's why utilities, defensive stocks, anything that gives you yield, I think is going to do pretty well in 2020.